We also have Willie here with us, who is also a faculty member. Elham, so you have the majority of our colleagues are actually here for your talk, so it's lovely. So this is this seminar with Elham opens our fall series, which will be a series that will involve a little bit less talks than usual, but talks of very high quality. So we begin an interesting discussion with Elham Saeidinezhad, who is now assistant professor at Barnard College here in New York. Elham has got her PhD from the University of Sheffield in macroeconomics, and since then has been working with many research institutes, starting from the postdoctoral fellowship at INET. I think that's when I met you, actually. Yeah. And then after that, she worked in Santa Monica with the Milken Institute. And now she's been working hard on the connection between monetary economics and finance. And I think she will be presenting her recent paper that she was telling me she's just concluded the first draft. So it's more than ever timely to get feedback from us. And so we're very happy to have you, Elham, and we hope for a fruitful discussion and that you'll gain some insight from the conversation with us. Thank you.
Thank you so much, Clara, for inviting me, and thank you so much for all of you for being here. It's a pleasure to be at New School, even if it is virtually for now. So I'm going to share my screen. Please let me know if you have any difficulty seeing can you see my slides? Perfect, great. So what I'm going to talk about today is basically some trends and also an analysis of the future of the FX swap market. So as you can see, the question that I try to answer is if the future of FX swap market dealerless. I'm going to answer this question from a perspective of a dollar funding, especially a global dollar funding. So what I'm going to talk about today, well, I'm going to start by introducing this topic broadly, and then I'm going to talk about key takeaways. By the way, this is going to be the conclusion, basically. And then I'm going to talk about a model of the FX swap instrument. More importantly, I'm going to show you basically, and hopefully I try to persuade you that the FX swap in nature is very close to the money market instrument. So I'm going to show that by looking at the architecture of this instrument and also by looking at the pricing. I'm going to talk about the very famous failure of cover interest parity and say that the failure of cover interest parity is indeed the success of FX swap as a money market instrument. After that, I'm going to talk about a few important trends that are changing the market structure of FX swap. Some of these trends are already mentioned here. And then I'm going to talk about how these changes in market structure are going to affect the economics of dealer function. Remember, our focus is on the economics of dealer, and we are then going to understand how these changes in the dealer's function going to affect market liquidity. Okay, so and then after that we are going to examine all of these changes on the economics of dealer function. Some motivation. Basically, where do I belong? This paper basically belongs to the several strands of international finance literature, and this literature, the new versions of this literature, is trying to understand this relationship between the FX swap liquidity and the global dollar funding gap. When it comes to the future of US dollar funding, however, most of this literature is still focusing on the US repo market and you ignore and overlook the trends that are changing the FX swap market. That's why in these literature or the papers that belong to this literature label the collapse or breakdown of the cover interest parity that we're going to talk about later as an FX swap mispricing. Okay. So what I'm going to add to this literature is that I'm going to basically focus on the FX swap dealing system. More particularly, I'm going to talk about the impact of the structural changes in the supply and demand side of this market on the balance sheet of the dealers. And then I'm going to talk about the effect of these changes on the pricing and the quantity of the dealers in the market, and how that is going to affect the price of US dollar funding in the other segment of the international monetary system. So there are four important structural changes that I'm going to focus. The first one, the three of them are going to be supply type shock, and the last one is going to be the demand shock. So what are the supply shocks? The first one is that there is this increasing competition from non-dealers in this market, especially an important type of non-dealer is a prime brokerage firms. And we're going to talk about why this matters for market liquidity. The second type of supply shock is that most of the non-US dealing banks are losing their access to the US bank facilities. The third supply shock is that there has been some changes on the way that the dealers in FX swap are quoting their prices. And the demand shock comes from the facts that international investors and also non-US banks have started to use FX swap in order to raise US dollar funding. So the problem with the current literature, as we just said, is that they are abstracting from the foreign exchange dealers. However, this abstraction is going to be an important obstacle for our understanding of the direct and indirect cost of access to dollar funding. Why this matters a lot? Because in most cases, actually, the international jurisdictions in the international monetary system are connected through these dealers. It is true that when the FX turnover is low, these market makers are central banks. So if your focus is only on the interest rates, you are fine. But in the majority, for the majority of the market, where the currencies that are being traded are the popular ones, especially the US dollar, we see that these jurisdictions are basically connected not through the central banks, but through private dealing banks. So we cannot really afford to abstract from these institutions. So what are the key takeaways after I finish my analysis? In terms of the international monetary system architecture, in the future, we're going to see that this system is going towards a less bank and less dealer-centric architecture or setup, which means that this indirect access to US dollar funding is going to be through alternative players, such as prime brokerage firms. So in terms of the offshore dollar funding liquidity, I think in the future, a lower market liquidity in the FX swap market, and also lower funding liquidity in the lower funding liquidity in the US dollar funding is going to be an important structure or an important aspect of this structure. So in terms of the architecture, we are moving towards non-banks. In terms of the liquidity, we are moving towards less liquid markets, both in the FX swap market and dollar funding market. So in terms of the cost, our interpretation of the CIP should change. The reason is that the CIP failure is basically the reflection that the demand for US dollar funding through FX swap market has just increased. And as a result, this basis, which is the measure of the CIP breakdown, is simply showing us that there is a premium in the US dollar funding market, which makes sense because especially during the period of crisis, the demand for the best form of currency in the world, which is the US dollar, increases even further. So again, remember, I told you that the liquidity is gonna decrease in the future. What is the implication of that for the crisis? This means that during the crisis, we are going to experience higher volatilities on these two markets. So this means that in terms of the pricing, we have to expect basis to increase even further in the future. So basically, we talked about the introduction, but let's talk about the model of an FX swap instrument. So an FX swap instrument is a synthetic asset, and we can see that, soon we can see that the dollar finance is an excellent example of use of this synthetics. So what is a synthetic asset? A synthetic asset is basically a contract in which an agent takes various positions, and in doing so, it tries to create the same cash flow structure as the underlying asset. And this is exactly what an FX swap does. At the end of the day, what an FX swap does is that it is a single portfolio of cash flows that are generated through two different transactions: the FX spot transaction and an FX forward transaction. So this is very similar to the repo, and we are going to show three techniques to show we are going to use three techniques to show this similarity. So we can see soon we are going to see that similar to a repo, an FX swap is a form of a collateralized loan, which means that from a monetary economics perspective, the important thing about FX swap that has made this instrument attractive in the market is that it is a form of secured lending. Okay. The first tool that we are going to use to show this similarity and this structure of the FX swap is this cash flow analysis. Look at the cash flow analysis here. In this case, we do have two legs. In the first leg, which is the starting date, the first transaction, which is the FX spot rate, is going, which is the FX spot transaction, is going to happen. And in this transaction, the FX spot rate is going to determine. What happens in this transaction is the following. Let's assume that we do have an agent or a bank, a British bank, and this British bank wants to actually, it does have pound, but it does need to actually raise some kind of dollar funding. So what it does here in the leg one is that it is going to use this British pound as a collateral in order to purchase dollar funding today. And the price that it is going to, and that this British bank is going to pay is going to be FX spot rate today. But this transaction, this FX swap transaction also has the second leg. And the second leg happens in the maturity date. Another important similarity between FX swap and a repo is that both are short-term instruments. So the maturity date is usually less than 1 year. In most cases, it is either overnight or a 3 month. So what happens in the second leg? In the second leg, we see that the bank A, which was a British bank, is going to repurchase those pounds, and bank B, which is, let's say, an American bank, is going to repurchase those dollars, but this time the price is an FX forward rate. So we have two transactions and two prices are determined here. The important thing about this transaction is that this FX forward rate, even though it is a rate that belongs to the future, is going to be determined on the leg one or first day of the transaction, or on the day of the transaction. That's why FX swaps has been traditionally used for hedging purposes, because if an investor, again, a British bank, enters such a transaction, it can basically lock in an exchange rate of in the future for the future transactions. So The other tool that we are going to use to show that in terms of the cash flows, there are similarities between FX swap and repo is an analytical contractual equation. As a matter of fact, once we use this analytical contractual equations, we see a similarity between the FX swap and not only a repo, but even a traditional bank loan. So let's do that together. So an important thing that these analytical contractual equations are going to show is that there's not only the FX swap is very similar to a bank loan, it also creates a form of hybridity between the FX swap market and money market. And again, this is exactly one of those inherent in structural characteristics that has made FX swap a very popular alternative to the traditional money market instrument. So in the first contract, in the first equation, what we are going to do is that we are going to simply replicate a portfolio of cash flows once an investor enters an FX swap contract. So what does happen? Remember, we said that the bank A, which was the British bank, basically have to use this the pound deposits that it already has in order to enter this contract. So in this case, we are assuming that this bank, in order to enter this contract, it doesn't have a deposit. Instead, what this bank is going to do is that it's going to actually borrow from the domestic money market. And this is basically like yeah, sorry, here I wanna, so in this equation, when I wrote it, I actually still assume that the bank has pounds, so it doesn't need to borrow from domestic money market. I just want to rewind that. So again, so we are still sticking to the previous assumption that this bank has already have this pound deposit, and all it wants to do is that it wants to raise dollar funding, and that's this deposit is coming from. That's where this deposit in this equation is coming from. So basically, what is happening here is that this bank is applying for a loan or asking for a loan, which means that it is going to borrow this USD. And the USD is going to mature at time T, which was the second leg of the transaction. At the same time, it is going to actually pay the American bank, for example, a GBP deposit, which means that this GBP deposit also going to be mature in let's say in one period, because this US bank should repay the British bank this British deposit. At the same time, another transaction is happening, and this is an FX transaction. And this is basically an FX spot transaction. And this transaction happens when one party purchases this pound and pays US dollar at time 0. So the result of this contract, as a result of these transactions, we can actually create an FX forward contract. The result of the FX forward contract is that the party is going to sell US dollar against GBP or British pound, and the maturity of this contract is going to be for 1 year. Again, there are a few transactions happen here, and these are the timing and the nature of the transactions that happen during these forward contracts. The first one is a loan, has the characteristic of a bank loan because one party is basically borrowing USD, and it has to repay this loan in a year. And the other party is receiving this USD, which means that it is able to is receiving this pound, which means that it is able to deposit this British pound for at least one period. In the meantime, there is a foreign exchange transaction, as you can see here, And the result of these three different transactions is this contract, which is called FX forward. So what we are going to do is that we are going to manipulate this contract in order, or this equation, and we are going to do so in order to create a genuine US dollar loan. So all we did was basically to restructure this equation. So what we did was that we basically moved this loan here to the right-hand side, and we do have this new equation. So the loan is the right-hand side, and we see that the loan, this US dollar loan, is as a result of these three equations. But the problem with this equation is that there are some minus signs here that makes understanding what these loans are in nature a bit difficult. And that's why we are going to manipulate this equation even further. In the third step, what we are going to do is that we realize that, for example, in this case, a minus of a money market deposit is basically a money market loan. And that's exactly what we wrote here, that a minus of deposit is equivalent of a loan. Also, a minus of a FX spot operation, when we assume that the party buys GBP and pays US dollar, is another FX operation, is another FX spot operation. But in this operation, the party purchases US dollar and pays British pound. And again, this is exactly what we wrote here. And the minus of an FX forward, so the FX forward is going to remain the same because there is no minus here. So basically, we did some manipulation and we got to this final equation. In this final equation, what we see is the following, that we genuinely just use the very transactions that happen through an FX market or FX swap market to create a genuine US dollar loan. So a US dollar loan can be constructed or engineered through these three separate operations. The important aspect of these operations is that these operations do not belong to only one market. Rather, they do belong to two separate markets, FX market and money markets. So the last tool that we are going to use in order to show that FX swaps in nature are very close to money market tool is a very simple balance sheet analysis. So in this case, assume that the investor is going to keep this pound deposit and is going to raise dollar funding through the US repo market. And the investor needs this the investor needs this US funding in order to purchase a dollar security. So here, this is basically what we have shown in this balance sheet on the right-hand side. This is a repo transaction, right? So the first example is basically an example of a repo, where what we did is that, or all we did was that we assumed that the investor was in this starting position. In this starting position, it has cash, and the cash is denominated in pound, and it has liabilities. The important thing about this balance sheet is that we are assuming that in the starting position, there is no debt, which means that most of these liabilities are in the form of capital, and the capital is denominated in British pound as well. Okay. The first example assumes that this British investor is going to repo market to raise dollar funding. So what happens in this transaction? In this case, this investor is going to purchase this security or dollar security, and in the meantime is going to use the very security to raise US dollar. So in a sense, the investor is using the assets that it wants to purchase as a collateral to purchase that very asset. And that's exactly what is happening in the repo market. So as a result of this repo transaction, we see that the balance sheet of this investor has expanded. So the balance sheet, the new balance sheet is going to be the following, that that on the asset side, we do have dollar securities. And on the liability side, again, remember we said that we have no debt, and rather we only have this capital, which is denominated in the British pound. So now, as a result of this financing, the balance sheet has expanded and it has this new component. In the new component, in the asset side, we have the cash, and on the liability side, we have the security. The only mismatch here, or the only apparent mismatch here, is that there's a mismatch in the FX, which means that these two, the assets and liabilities, are actually denominated in different currencies. However, once we look at both the upper side and the lower side of the balance sheet, we see that even this apparent FX mismatch is going to disappear, because even though on the liability side, in the forward leg, or in the case of repo, on the second leg of the transaction, we do have security that is denominated in the US dollar, but this investor managed to raise some US dollar funding at the beginning or at the first leg. And that's why this investor has an asset that is denominated in the US dollar. So there is not even an FX mismatch here. But now let's assume that instead of going to the repo market, this investor is going to FX swap market. So what happens here? Conventionally, because we show FX swap operations through netting, the balance sheet is going to be this one, which is in the net basis. So in this balance sheet, you see that the final outcome is that this investor has managed to purchase the security, and the security is denominated in the US dollar, and it has managed to keep exactly the same kind of capital as it had before. Having said that, there is this apparent mismatch here, right? The only problem with this operation is that there is this like FX mismatch here. But in the meantime, there is no increase in debt or anything like that. So the investor managed to actually go to the FX swap market, raise dollar funding, purchase that US asset, and without actually increasing his debt, the net effect is that it is only exposed to foreign exchange risk. But once we use gross basis to show all the transactions that are implied in the FX swap, we see that the story is very different, and it's very similar to what we see in the repo. So what is different here? So in the first leg, remember, we said that so you are going to swapping your asset, and if previously you had this cash which was denominated in the British pound, now you do have a security that is denominated in US dollar. But in the second leg of the FX swap, you are promising to reverse this transaction, which means that you are promising to basically pay the let's say US dealing bank the same amount of US dollar that you have borrowed at the beginning of the transaction. So this means that on the liability side, there is this implied commitment. There is this implied or implicit debt. And this debt, we are going to say that because it is not reflected explicitly in the balance sheet, it is part of the missing debt is in international monetary system. But so one thing that is different once we change the accounting practice from net basis to gross basis is that we see that the FX swap is going to generate some debt. But remember, we said that once we use the net basis, we see that there is this apparent mismatch in the foreign exchange, or there's this like FX foreign exchange mismatch, which means that the assets are denominated in different currency from the liabilities. But once we actually show all the implied transactions in the balance sheet in the FX swap, we see that there is no such mismatch. Exactly the same thing as the same argument that we made earlier for repo, we can say that yes, it is true that you have this kind of like future commitment that is in the US dollar, but your today's asset is in US dollar as well. So if you look at the overall exposure that you have in your balance sheet, your exposure is not in form of foreign exchange exposure, but still you do have some kind of implied commitment that belongs to the future. And that implied commitment or IOU or debt, again, is something that is missing in the standard depiction of the FX swap. We show that, but these balance sheets are showing that, what these balance sheets are showing us is that there are similarities between foreign exchange swaps and the repo. In terms of the cash flows and the timing of the cash flows, these two instruments have similar assets and liabilities. In both cases, both for the case of FX swap and repo, when the investor decides to raise US dollar, it is actually not, the investor is not exposed to the foreign exchange risk. However, there are fundamental differences between the FX swap and the repo instrument. The first important difference is that the liabilities and assets in the FX swaps are implied. In the meantime, these liabilities and assets are explicit in the repo market. The second important difference is that the type of collateral that is being used in these two markets or in these two instruments are different. Remember, when we talked about the repo market, we said that what you're going to do is that you are going to use your US dollar denominated security as a collateral in order to raise dollar. So what is the collateral here? In the repo market, your collateral is a form of security. However, in the FX swap market, your collateral is a currency that is denominated in another currency. It's not a security, it is a currency. So why this matters? The first thing that before talking about why this difference in the type of collateral matters, I'm going to talk about the first disparity between the FX swaps and repo, which was this implied versus explicit liabilities. So the current accounting conventions in the derivative market basically treats all these implied commitments in the FX swap market as a form of off-balance sheet, accounting. So this means that in this balance sheet, this debt here that basically exists and it should be fulfilled in the by the investor who has purchased this, this asset and funded that asset in the FX swap market in the future. So this very debt that exists in the market is not going to be accounted for in the international monetary system because this debt is actually treated as an off-balance sheet instrument. So there is this problem of missing debt that is accumulating in the international monetary system. The other important difference between the swaps and the repo is that in terms of the collaterals that are being used in these two instruments, these collaterals do belong to different layer of the hierarchy, currency hierarchy. So let's talk about the repo market. We said that in the repo market, the collaterals that we use is usually US Treasuries or the other fixed income securities in the US market, or other fixed income securities in the US capital market. So, however, in the FX swap, the currency is a bank deposit that is denominated in another currency. So here I want us to look at this kind of like this structure here. So the treasuries here, and also the US, so this basically black diagram here shows the hierarchy of the currency and financial instrument. So in this hierarchy, you see that, well, at the very top of the hierarchy, we do have the US dollars. And the US dollar, both in terms of instrument and in terms of the currency, is the best form of financial asset, let's say. At the second layer of the hierarchy, we do have US Treasuries. US Treasury, in terms of instrument, is still the promise to pay US dollar, but in terms of the currency, it is denominated in US currency, which is the world's vehicle currency. So in that regard, we do have US Treasuries as the second layer of this hierarchy. What about the third layer of the hierarchy? These US dollar securities. This is basically, let's say, other fixed income securities. So these securities are either the promise of paying a better type of security, which is the security that is issued by the US government, or is the promise to pay US dollar. So in terms of the hierarchy of financial instrument, it is at the third layer of the hierarchy. However, it is still denominated in US dollar. That's why it is at a higher layer of hierarchy compared to other foreign currencies. So I want us to look at this. Hierarchy, because the treasuries and US dollar securities, these are the two collaterals that we use in the repo market. However, foreign currencies is the type of collateral that we use in the FX swap market. So in terms of the hierarchy, what we're going to see is that the treasury that is being used, the collateral that is being used in the repo market is a better type of collateral than the FX swap. So what is the implication of that for FX swap pricing? I'm gonna start by talking about current interest parity, because an important theory that basically like defines the pricing of FX swap is the CIP. What is the current interest parity? The current interest parity, in a sense, says that because all these instruments are very close to each other in terms of and they can be used as alternative assets, their rate of return should be equal to each other, which means that at the end of the day, the interest rate differential between the two currencies in the cash market should be equal to the implied swap rate. Okay, so the interest rate differential between two different currencies determine the rate of return of investing in these two currencies in different markets. And this interest rate differential this rate of return should be equal to the rate of return of investing in FX swap market. And the rate of return of investing in the FX swap market is implied FX swap rate. So CIP basically said that the forward rate, which is the implied FX swap rate, should be equal to this interest rate differential. However, as you can see here, this just in terms of the actual financial market, this just doesn't make sense because the type of collateral that we use in FX swap pricing has lower quality compared to the collateral that we use in the money market in this case repo market. This means that if a US dollar investor wants to actually land in the FX swap market because it is receiving a lower quality collateral, naturally it should ask for a kind of premium, because again, in terms of the collateral, it is receiving a lower quality collateral. But this premium is exactly what the CIP assumed doesn't exist. The CIP doesn't assume such a premium doesn't exist because it is not based on this, or it ignores this hierarchical structure of financial instruments and currencies. So the breakdown of the CIP, which in the standard theories is called as FX swap mispricing, and also refers to the existence of this basis or premium, is basically the reflection of the true pricing of the underlying collaterals. Because again, one of the collaterals belong to a lower layer of hierarchy compared to the other collateral. And in the asset pricing, we know that when we are facing such a kind of risk, we have to price that risk. And the premium and the existence of premium is only an implication that the market is correctly pricing that risk. However, this hierarchical structure is not the only explanation behind the persistence and the existence of the basis and the breakdown of the CIP. We're going to go through other factors that are creating this basis basically persistent, but an important factor that is usually missed is again this hierarchical structure of the collaterals that are being used in these two different types of market, even though these markets are highly hybrid. So I said that there are other factors that are contributing to the breakdown of the CIP and therefore the persistence of the basis or the premium in this market. So in order to understand why those factors matter, I want us to review something very fundamental about CIP, which is basically the assumptions behind covered interest parity. The first assumption is that we are assuming that markets are liquid and also there are no transaction costs. There are no bid-ask spreads, and this is the spread that the dealers are going to charge. So basically this market assumes that there is no dealer because there is no spread. It also assumes that there is no credit risk and no counterparty risk. So we are going, as the literature has already shown, and the empirical literature has already shown, in most cases, the CIP, which is a kind of no arbitrage condition, is breaking down in the presence of such factors such as the widened dealer spread and also the reduction in the inter-dealer market activity. Obviously, CIP cannot consider or capture these important market structures because by assumption, it assumes that there is no spread. And that's why the return on these two different markets are going to be similar. So again, for now, it's important to know that an important feature of the modern market is basically this widening of the dealer spread, and this is influencing this pricing in the FX swap, and it is influencing the pricing in FX swap, and not because of the accident, but because it is violating one of the important assumptions of the CIP, which is basically the most important theory that we use for FX swap pricing. So we are going to talk about these things, that why this basis is going to persist, but in a nutshell, so the market structures are changing, and we have already talked about, we just introduced 4 of this important market structure, but we are going to go through this different market structures, and we see that these market structures are basically leading to the higher dealer spread. And again, the higher or the widening of this spread consequently means that the CIP violation is going to increase as well. So the second important reason that the basis persists is that the banks are increasing their demand for FX swap to manage their short-term dollar funding requirements. We said that, well, because in this case, the banks are posting a lower quality collateral. If they want to act compared to going to the repo market directly, if they want to actually raise dollar in the FX swap, they have to pay a form of premium. And this premium is exactly exactly what we are seeing here. Clara, would you remind me how long? Okay, I do have 13 minutes. Clara?
Yes, if you want to have, it's good, I think, if we keep half an hour for questions, but if you need a little longer, go ahead.
I may need a little longer, but I also try to, do it a bit faster. But thank you so much for the message. So let's talk about the model of FX swap market. So by that, I want to start by looking at the microstructure. So if you look at the microstructure of the FX swap market, we see that this is a two-tier market. In a sense, the largest segment of the market, at least traditionally, was this inter-dealer market. The main players in the inter-dealer markets were the dealing banks, and these are usually non-US banks. So this is an important thing to remember, because one of the structural changes that we are going to talk about is that the share of this inter-dealer bank is shrinking. And this is going to have implication for the FX swap, for the dealers spread, and consequently for the FX swap pricing. So the other important point that I want you to notice here is that we do have a new form of, financial intermediary, which is called prime brokers. And in terms of the level of transactions and the volume of transaction or market share, the prime broker basically are catching up with these dealing banks. Yuki, do you have a question? Okay, yeah. The prime brokers are catching up with the dealing banks. So this is actually another structural change that we just introduced. So again, one structural change is that basically the share of this blue space is falling. And the second structural shift is that the number of these dealing banks are decreasing, and the number of these prime brokers are increasing. And we are going to talk about why this matters. The third structural change, we talked about it several times, is that the reason that these clients are coming to the FX swap market is changing as well. Previously, they used to come because they wanted to hedge their position. Now they are coming because they want to actually raise US dollar funding. So on the supply side, an important change in the FX swap market is that the prime brokerage is increasing. Also, in terms of the inter-dealer market share, which is especially the part of this market share that represents the activities of the dealing banks, is declining. And in terms of the other important supply side change is that the dealing banks need to be funded. Usually, they were able to fund each other in the inter-dealer market. However, because the banks are leaving from this market, a new type of financial intermediaries, mostly money market funds, has started to fund the existing or remaining remaining dealing banks in the FX swap market. We are going to see why this is going to increase the FX swap spread, and why this is going to decrease the liquidity in the market. So there's also a shift in the demand side, and the demand side is that, again, the clients are coming to the FX swap market for funding liquidity purposes rather than hedging purposes. So in this paper, I have developed two different measures of global dollar funding, which is basically bid-ask spread and CIP deviation, in order to capture the in order to measure and capture dollar funding condition in the FX swap market. So I have already talked about these two criteria or measures that I have in my mind whenever in order to assess the dollar funding condition in this market. But there are also like some kind of but also in the next slide there are I'm formalizing this thought, and basically like the idea here is that, well, an important measure is this spread, and especially the midpoint of the spread is the price of the having access to liquidity in the FX swap market. And basically this is following Banti and Filatkis in 2009, that basically they created such a measure, and then they split the FX swap market into two different categories. The one in one category, the major players in the interdealer market were dealing bank. On the other category, the major players, they were prime brokers. And what they saw is that this spread, which is the measure of like the cost of access to dollar funding in the FX swap market, increases dramatically when there are less dealing banks. So basically like these are these two criteria is coming from these BIS papers. And so this is the bid-ask spread, and this is again some equation to describe that formally. But again, the other important criteria is the CIP deviation. We already talked about why CIP deviation is the measure of dollar funding. Remember, we said that part of the CIP deviation is explaining the fact that if you go to the FX swap market in order to raise US dollar funding rather than going to the repo market, you are using a lower quality collateral, and therefore you have to pay premium for that. And that premium is a CIP deviation, which means that once the CIP deviation increases, the premium on the US dollar funding increases as well, and the liquidity condition is going to fall. This relationship between the increase in the premium and the decrease in the funding liquidity condition is well established, especially in this paper, Kron and Sushko, which was published just this year. So the last measure of understanding dollar funding through FX swap is through this. It's a quantity measure rather than a price measure. The quantity measure is basically trying to capture the competition in this market, especially the competition amongst FX dealers. Because one of the changes in the market structure was that the prime brokerage firms are actually entering the market. So in a sense, that's also an increase in competition. But this competition is not what is counted in this measure, because the existence or the rise of prime brokerage firms are going to actually deteriorate market liquidity and in the FX swap market and funding liquidity in the US dollar market. It is only an increase in the competition between the dealing banks that is going to actually improve liquidity in both markets. And so basically, so now let's talk about the effects of each of these shocks or in structural changes on the liquidity. So the first one was the emergence of money market funds as the dollar suppliers to these non-US dealing banks. Because before the financial crisis, and especially before the introduction of some of the prudential regulation by financial regulators, the US banks were the main providers of the dollar funding to these non-US dealing banks. However, because of the financial regulation, banks have exited the market and money market funds are replacing them. So why this matters to us? Again, I want us to look at this hierarchical structure, but this hierarchy is the hierarchy of financial institutions in the market. So at the top of the hierarchy in this international monetary system, we do have the Federal Reserve. At the second layer of the hierarchy, we do have the US dealing bank. Why this matters? Because if your funder is a US dealing bank, it is very likely that you are going to receive cheap funding. Why? Because these US dealing banks have direct access to the Federal Reserve balance sheet, and their own cost of funding is as low as risk-free rate, which is measured by the OIS, or overnight index swap. So in the third layer of the hierarchy, we do have the C5, which is basically the 5 major central banks that have permanent swap lines with the US central bank, which is or Federal Reserve. So why these central banks matter? Because these central banks are able to lend to their own banks at a cost that is as low as the US dealing banks. So this means that the very fact that the US dealing banks are exiting the market, at least for this for the other banks that belong to the C5 or to these 5 countries, is not going to be a major change. Still, it is going to increase their cost of funding, but the increasing cost of funding is not going to be as important. However, so these central banks only basically provide funding to these banks in their jurisdictions during the crisis. Without the crisis, there is this new financial intermediaries, which is the US money market funds, that are actually going to supply funding to these non-US banks. So in this case, it is true that money market funds, in order to remain competitive, it is not going to charge higher prices. However, the money market funds by nature, they are not a stable liquidity providers. And the main reason is that they are actually they don't have direct access to the Federal Reserve balance sheet. After the COVID-19 crisis, the Fed established a credit line with these money market mutual funds exactly to stabilize this market, but that was only for a few months. For other foreign dealing banks, for the dealing banks that do not belong to the C5, to this these countries, these major countries, the fact that the US banks are exiting the market implies that the cost of access to liquidity is going to increase dramatically, and an increase in the cost for access an increase in the cost implies that they are going to charge higher spreads. So in order to understand the relationship between access to liquidity funding or access to dollar funding and the spread that they're going to charge, we are going to use the trainer model in order to understand how basically dealers in different markets connect the price that they receive from their own funders to the price that they offer to the rest of the market in terms of the implied swap rate. So again, because of the time, I'm not gonna go through all the details of the trainer model, but the point to emphasize here is that the point to emphasize here is that, in the before these structural changes, when the US dealing banks were the primary funders to these non-US dealers, then the cost of funding for these non-US dealers, as you can see, was very small. Here, this a spread between OIS and reverse repo is basically the cost of funding for these non-US banks, which means that these non-US banks, could actually cover their liquidity need at a very low price. As a result of that, they were managed to charge a spread dealer, a dealer spread in the FX swap market that was not considerably high. And this mid price between bid and ask spread was basically the price of FX swap, the implied FX swap rate. But once we actually change this US dealing banks with the US money market funds, we see that all of a sudden the cost of dollar funding increases dramatically. So here you see that, for example, previously this line here, the lower line, basically represents the cost of the US money market funds themselves to get access to funding. And here is, let's say, OIS, which is the risk-free rate plus one standard deviation. And then the upper line, the upper dash line, this black line here is representing the price that they ask in order to basically offer liquidity funding liquidity to these FX swap dealers. And because the cost of access to liquidity for these US money market funds is not as low as the US dealing banks, they are going to actually charge higher prices in order to lend to these dealing banks. And these higher prices in the money market implies that the FX swap dealer spread is going to increase in the FX swap, spread is going to increase in the FX swap market as well. Remember, this midpoint, which is this mid spread, is the price of having access to the US dollar funding for the rest of us, for the other non-banks. So here you see that there's this spillover, and the spillover effect is gonna worsen if the US banking system exists and US money market fund basically like replace the banking system. In a sense, because the money market funds don't have access to the cheap funding themselves, they are going to ask higher prices. This means that the cost of funding for the FX swap dealers are going to increase, and they are going to charge higher prices in the FX swap market as well. And as a result of that, the other banks, non-US banks that are going to the FX swap market to get access to the US dollar funding are going to face higher prices. So the second important supply shock, or the second important change in the market, is this decline in the share of inter-dealer market, that blue box in the FX swap market structure that I showed previously. And especially the part of this blue box is shrinking where the dealing banks used to actually operate. So this basically shows that these four diagrams is based on the review of the literature. And once we review the literature, we see that this is the process that used to happen, that was already in the making, basically, and used to happen and started to happen from 1980s. Once we start to have this like kind of revolution in terms of like the introduction of like computer training and digital training. So, but as you can see, as the market, so this green area is showing the market loss actually. As you can see, as the market share loss is increasing, the dealer's spread is increasing as well. And again, this is a trend that is continuing, that has already been in the making and is going to continue in the future as well. So we said that the second important structural shift was that the dealing banks, this one refers to the non-US dealing banks. The non-US dealing banks are exiting the inter-dealer market. And as a result of that, we see the spread is going to increase. Remember, we said that the spread is the measure of two important things: the market liquidity condition in FX swap market and the funding liquidity condition in the global dollar funding market. So the third important changes was the prime brokerages, and the fact that in the interdealer market, the dealing banks, the non-US dealing banks, are exiting the market, and prime brokerages are entering the market. I'm not going to go through the economics of the prime brokerages, but the important thing to remember is that there are major differences between prime brokerages and the dealers. And the important difference is that, so again, I'm gonna skip this because the important difference is that, as you can see, so there are some good differences. So I see there is this, okay, sure. So I'm gonna wrap up in 5 minutes. So the important differences is that the important difference between the prime brokerage firm and the dealing banks is that in the case of the prime brokerage firm, so in the case of the dealing firms, in order to actually, in the case of the dealing firms, in order to make sure that all the trades are going to happen, these dealers are going to use their own balance sheet, which means that every time there is a trade, every time that there is a trader and wants to get rid of his position, even if there is no potential buyer, the dealer is going to be the buyer here, and it is going to absorb this trade into his own balance sheet. And in the process, what it's going to do is that it is going to ensure that the cost to the trader remain insignificant. So because one of the important role of the dealer is that you absorb these imbalances into your balance sheet, but you are not going to change the prices. But this is not the way that the prime brokerage firm function. The prime brokerage are not going to, a prime broker is not going to use its own balance sheet. It's only going to use its own name, which means that in this case, if a trader wants to get rid of his position and there is no potential buyer for this position, then what the prime broker should do is that it has to actually offer higher prices, which means, and remember, we said this difference between bid and ask price, or the spread, is a measure of funding liquidity in the global dollar market and market liquidity in the FX swap market, which means that by design, prime brokerages, because they are not absorbing any imbalances into their own balance sheet, they are going to cause this spread to widen, especially when there is a imbalance in the market. And as a result of that, the liquidity condition is going to deteriorate. And the last thing that I want to discuss is basically something that we have talked about a bit more than the previous structural changes. And that's the fact that the demanders or the clients in the FX swap, they are there for different reasons. In the past, they were there because they wanted to hedge their foreign exchange positions or foreign exchange exposures. Now they are there because they want to have access to the dollar funding. And as we said earlier, if you look at the hierarchical structure of the international monetary system, this means that the cost of access to dollar funding is going to increase. And because of a few reasons. First, the demand for dollar funding is increasing in this market. And second, as we said, the underlying collateral in this market has lower quality compared to the rest. Compared to the collateral that is being posted in the repo market. So as a result of that, this kind of demand shock, which is an increase in the demand for the FX swap, is going to systematically increase the spread as well. So if I want to conclude what everything that we discussed, so this basically try to conclude this. But all these factors that we have identified are going to increase the spread in the FX swap dealer systematically, which means that they are going to reduce liquidity both in the FX swap market and global dollar market funding systematically as well. In the meantime, some of these factors are going to are directly contributing to a reduction in the competition amongst dealers, which going to increase this spread further. So in overall, if we want to look at if we want to see where the FX swap market is going, and more importantly, where the US dollar funding is going, the FX swap market and the dollar funding market are going to see higher rates, systematically higher rates in the future. And and in terms of the institutions, they are going to be less dealer centric. Thank you so much for listening to this presentation. And also, if I talked more than I should have, sorry for that. But thank you so much for listening.